Pop quiz, hotshot. Is getting a big tax refund a good thing? Most people would say yes. They get excited about it. They plan vacations and big purchases around it. There are entire marketing campaigns and even Super Bowl commercials built around tax refund season. Unfortunately, a tax refund is not free money falling from the sky. It's the government returning your money that you overpaid in taxes from the prior year. You essentially gave Uncle Sam an interest-free loan, and now he's paying you back without a penny of interest. And these aren't small numbers. For the 2026 filing season, the average refund was around $3,300. That's $3,300 you could have had in your own pocket last year, earning interest or getting invested. Most people are pretty clueless when it comes to the tax code, and for a lot of people, that's actually totally fine. If you're an hourly worker who maybe makes a few stock trades on Robinhood, there really isn't much to optimize for from a tax perspective. Your taxes are your taxes, and they get automatically withheld from your paycheck. There's no secret button that you're forgetting to press. Most of the so-called tax loopholes you hear about in the news don't apply to you. When a headline says some billionaire paid a 3% effective tax rate or some mega corporation paid 0, those strategies involve things like offshore entities and depreciation of massive real estate portfolios that are cooked up by high-end tax attorneys and CPAs. That stuff is not applicable to the everyday person. Fortunately, there are a handful of completely legal and legitimate tax strategies available to the everyday person. You've probably heard of a few of them. And the goal today is not to turn you into a tax expert. It's just to plant some seeds of awareness. Because when the right situation eventually pops up in your life, you'll know at least a tax strategy exists, and you can decide to look into it further. Let's walk through 5 of them. Investing in tax-advantaged retirement accounts is probably the most well-known and most accessible tax strategy available to the everyday person. If your employer offers a 401k, you have access to one of the best wealth-building tools and legal tax breaks currently in existence. Here's a quick and dirty version of how a traditional 401k works. Normally, you earn money, you get taxed on it, and then whatever's left over after taxes is yours to spend or invest. A traditional 401k changes this up. When investing in a traditional 401k, the money you contribute goes in before taxes are taken out, which lowers your taxable income for the year. Let's do a quick example. Say you make $60,000 a year. If you contribute $6,000 to your traditional 401k, the IRS now sees only $54,000 of taxable income. You've effectively made $6,000 of your income invisible to Uncle Sam for the year. If you're in the 22% federal tax bracket, that's around $1,300 of tax you didn't pay. Money that instead gets to sit in your account and grow for decades. For 2026, you can contribute up to $24,500 into a 401k. Now, you certainly don't have to contribute this full amount. If your employer offers a matching contribution, contribute at least enough to get the full match. That's about as close to free money as you'll ever find, and that would be my advice as the minimum amount you should contribute. If you don't have access to a traditional 401k, the IRA, or individual retirement account, works on a similar principle, with a lower contribution limit of just $7,500 for 2026. You will eventually pay taxes when you withdraw money in retirement, which for this purpose begins as early as 59.5 years old. But this tax strategy is powerful because you're deferring taxes for decades and letting the full pre-tax amount of your contributions compound in the meantime. I'm not sure if a lot of people know what capital gains are, let alone what long-term capital gains are. And I'm pretty sure most people don't know that you get preferential tax rates on long-term capital gains. This tax strategy is criminally underappreciated by the average person, and it can make a real difference if you invest. When you sell an investment, a stock, a mutual fund, a cryptocurrency, whatever, For more than you paid, that profit is called a capital gain for tax purposes. The tax rate you pay on that capital gain depends on how long you held the investment before selling. If you held the investment for 1 year or less, that's a short-term capital gain, and it gets taxed as ordinary income. The same rates as your regular paycheck, which could be 22%, 24%, 30% or more, depending on your tax bracket. But if you hold the investment for more than 1 year, your profit becomes a long-term capital gain, and it gets taxed at dramatically lower rates, either 20%, 15%, or 0%, depending on your income. Yes, you heard me correctly. Long-term capital gains can be taxed at 0%. For 2025, if you're a single filer with taxable income under $48,350, your long-term capital gains are taxed at 0%. For married couples filing jointly, that threshold is $96,700. Let's walk through an example. Say you bought some stock for $5,000 and it grows to $8,000. That's a $3,000 gain. If you sell after 11 months, that $3,000 gets mixed in with your regular income and is taxed accordingly. But if you just wait until you've held it for a year, you flip the game into long-term capital gain territory and potentially pay a much lower rate. Or if your income is modest that year, nothing at all. Same investment, same profit, wildly different tax bill, and the only difference was a little patience. One important takeaway here is that these preferential tax rates on long-term capital gains make short-term stock trading costly from a tax perspective. I know there are people out there who dream of day trading as a side hustle. They think they can read up on certain companies, buy stock, then sell that stock a few months later to realize a profit. But if you aren't holding the stocks for at least a year, then the profit will be treated as ordinary income. If you already make a decent amount of money from your regular job, you're looking at a marginal tax rate of 24% or higher. But if you held the stock for a year and got long-term capital gain treatment, your tax rate on the profit would be at most 20% and possibly 15% or even 0%. It's already a losing proposition for the vast majority of people to try to make money through short-term stock trading. And the potentially massive difference in tax rates between short-term and long-term capital gains only makes things worse. If I had to pick the single most underrated tax break available to the everyday person, it might be the health savings account, or HSA. It's probably the singular best tax advantage account out there in the entire tax code, though of course there are some limitations. Here are the advantages. 1, the money you contribute is tax deductible, so it lowers your taxable income for the year, just like a traditional 401k. 2, the money grows tax-free while it sits in the account. Any interest or investment gains are not taxed. And 3, when you withdraw the money to pay for qualified medical expenses, that's also tax-free. So money goes in tax-free, grows tax-free, and comes out tax-free. There's nothing else quite like it. But there's a few important caveats. 1, you can only contribute to an HSA if you're enrolled in what's called a high deductible health plan, or HDHP. These are health insurance plans with lower monthly premiums but higher deductibles. Some companies may not offer one, and even if it is offered, an HDHP isn't right for everyone's health situation. 2, the contribution limits are pretty low. For 2026, you can contribute up to $4,400 if you have self-only coverage, or up to $8,750 for family coverage. And 3, withdrawals from the account must be used for qualified medical expenses, or else you lose the tax-free advantage. There is definitely leeway here for qualified medical expenses. More leeway here for qualified medical expenses than with typical health insurance plans, but you are still limited. You can't use HSA funds to buy a Lazy Boy recliner, even though you can make the case it improves your back pain. One more thing worth knowing, once you turn 65, the HSA becomes even more flexible. At that point, you can withdraw the money for any reason without penalty. You'll just pay ordinary income tax on non-medical withdrawals, which makes it function a lot like a traditional 401k. But medical expenses stay tax-free forever. Considering that healthcare is one of the biggest costs that people face in retirement, having a pot of tax-free money earmarked for exactly that is certainly nothing to sneeze at. Not every investment goes up, and when one goes down, there's actually a way to turn that lemon into a little bit of lemonade. It's called tax loss harvesting. The idea is straightforward. When you sell an investment at a loss, you can use that loss to offset gains you made elsewhere, which reduces your overall tax bill. Here's an example. Let's say in a given year, you sold one stock for a $4,000 profit. Normally you'd owe capital gains tax on that $4,000. But let's say you're also holding another stock that's currently down $4,000 from where you bought it. If you sell that losing stock, the $4,000 loss cancels out the $4,000 gain, and now you have zero in capital gains and therefore zero tax. If your total capital losses for the year exceed your total capital gains, you can use up to $3,000 of that excess loss to offset your ordinary income, i.e. your regular paycheck income from your job. And even if you have more losses than that, you can carry the losses forward to use in future years. So a loss is never fully wasted. There are investment platforms out there like Betterment that automate tax loss harvesting for you to make sure you're buying and selling stocks in the most tax efficient way possible. Did you know that if you sell your home, you can exclude part of the profit from taxes? This might be the single biggest tax break most ordinary people will ever use in their lives. It's known as the Section 121 exclusion. When you sell your primary residence for more than you paid, that's a capital gain, just like selling a stock. And normally, gains are taxable. But Section 121 lets you exclude a massive amount of that profit from your taxes entirely. If you're single, you can exclude up to $250,000 of gain. If you're married filing jointly, you can exclude up to $500,000. The main catch is what's called the 2 out of 5 rule. To qualify, you must have owned your home and used it as your main home for at least 2 out of the 5 years leading up to the sale. Let's say a married couple bought a house for $300,000, lived in it for 8 years, and then sold it for $700,000. That's a $400,000 profit. Without Section 121, that entire $400,000 could be hit with capital gains tax. But because they satisfy the 2 out of 5 rule, their entire $400,000 of profit is not taxed, as it's well within the $500,000 they're allowed to exclude from taxes per Section 121. That's potentially tens of thousands of dollars in taxes saved, and exactly why awareness matters. Imagine having an opportunity to sell your home, but you don't realize this rule exists, so you make decisions based on a fear of a huge tax bill that wouldn't even apply to you. Or worse, imagine selling your home a few months short of satisfying the 2 out of 5 rule and accidentally forfeiting the entire exclusion when waiting a little longer would have made your profit tax-free. So there you have it. Remember, you don't need to become a tax expert. You don't need to memorize the tax code or spend your weekends reading IRS publications. But it pays, sometimes literally tens of thousands of dollars, to have basic awareness that these strategies are out there. Contribute to that 401k, at a minimum enough to get the company match. Wait at least a year before you sell an investment. See if an HSA is an option at your work, and if you want a super tax advantage investing account and or you're worried about future medical expenses. Remember that capital losses can offset capital gains, and know that when you sell your home, a huge chunk of the profit may be completely tax-free. The whole point is this: when the appropriate life event eventually happens to you, you sell a house, it's open enrollment season for health insurance plans at your job, the stock you've been holding finally soars, you'll have that little voice in the back of your head saying, wait, I think there's a smarter way to handle the taxes on this. A little knowledge goes a long way. And one final important disclaimer. I am a CPA, but I am not your CPA. And this video is general education, not personalized tax advice. Everyone's situation is different, and the rules have nuances and exceptions that I didn't get into here. When one of these situations actually comes up in your life, that's your cue to either do some deeper research or sit down with a tax professional to make sure you get it right. What do you think? Does this apply to your life? Leave a comment below, and thanks for watching.